Welcome back to the Long Call Option Masterclass. I am Stephen Cox, CEO and financial trader. At Share Navigator, we believe that education is financial trading power. This is episode 5 of a 6-episode masterclass where we continue our in-depth analysis of the long call strategy. And we're going to use the Apple $240 call option as our example. So just to quickly recap, on October the 17th, when Apple was trading at $252.40, we acquired the $240 call option, which expires in 90 days for a cost of $2,215. In our previous videos, we established the contract basics, calculated profit and loss outcomes. We benchmarked the long call against simply buying a stock. And we also discussed two of the Greeks, delta and theta. So we'd encourage you to go back over those videos if you missed them. But today we're going to cover gamma, which is the delta gas pedal, and Vega, which is your exposure to market volatility. First up is gamma, and I like to think about gamma as the gas pedal for delta. So in episode 3, we said to you that delta changes as the share price moves, and the rate at which delta changes is dictated by gamma. So for example, you're looking at a screen here with a quote, and the gamma is 0.01 for this Apple $240 call. That means that if Apple goes up by $1, the value of the delta goes up by 0.01. And in this example, it will go from 0.696 up to 0.706. So that's the impact of gamma. So for every $1 increase or decrease, the value of the delta will move by 0.01. And here's the great news. You're not going to need to sweat the mat. Online brokers do all the heavy lifting for you and do all of these calculations. In the final episode of this masterclass, we're going to show you how to use those online trading platforms and how to look at the profit and loss tables and the impact of the Greeks. We just feel it's important for you to know and to have knowledge of what gamma is and what does it mean for delta. Last up is Vega, and you may remember from an earlier episode, we discussed the time value of an option and how implied volatility is an important part of that. Well, Vega measures the change of an option's price due to a 1% change in implied volatility. So in this example here, current implied volatility for our 240 call is 27.2%. If that increased to 28.2%, the value of our call option would increase by 0.452. And likewise, if implied volatility decreased to 26.2%, the value of our call option would decrease by 0.452. Now, it's important to understand that we're assuming the share price hasn't moved in this example. Obviously, if the share price moves, the delta impact comes into it as well. The risk with buying call options is the volatility crush. So if you buy a call option when implied volatility is high, like for example, just before earnings, because of the unknown of earnings, the implied volatility is usually up. And then after earnings, the implied volatility drops, your option premium loses value due to Vega. And that's even if the stock moves in your favor. I've often seen share prices move up after earnings, but the value of call options actually go down. And the reason for that is the volatility reduces, the implied volatility Vega part reduces the value of the option. So the key to this is make sure you buy call options when the implied volatility is low. If you buy it when it's high, you're asking for trouble. That's it for gamma and Vega. So just a quick summary here. Gamma, just think of it as the gas pedal for delta. So it's the rate of change of delta for a $1 move in the underlying share price. And then Vega is your implied volatility measure. And really the key takeaway there is don't be buying call options when implied volatility is high. If you do so, it's harder to make money and profit from that. Coming up in the next episode, we're going to bring it all together. We're going to actually place physical trades in an online trading platform, show you how to do that, how to look at the profit and loss tables, and then the guidelines for buying call options and for managing the trade on an ongoing basis. But if you would like to fast track your learning, why not consider taking a free trial of our mentoring service? This is where I would work with you one-to-one, establish where you're at your level of experience, and start building on your knowledge from there. You will have access to me and to other members of Share Navigator on a daily basis, And you'll also learn from our real-life trades. We share all of our trades with video updates every day as to what we're trading, why we're trading them, and when we're exiting them. This is the best way for you to learn. If you would like to take a free trial, please reach out. No obligation. We'll have a one-to-one web meeting for 30 minutes, and you can assess then whether our mentoring service is right for you.